Welcome to Dollars and Cents with your host, Jeff Davis and Chris Coleman from Falcon Financial Management.
Good morning, Gainesville, Ocala. It's Saturday, March 16th, and you're listening to Dollars and Cents with your hosts, Jeff Davis and Chris Coleman. Jeff Davis, certified financial planner, president of Falcon Financial Management, creator of the integrated wealth management process, and a man recognized by Barron Magazine as one of the top 500 independent advisors in the country. My name's Chris Coleman. I'm the managing partner at Falcon Financial Management. And behind the glass, we have Miss Lisa Meadows. Lisa, how are you today?
I'm doing fine. Just looking forward to that warm weather that's coming today.
There's a rumor. I almost made the mistake of coming outside in a short sleeve T-shirt today and then thought that warm weather's soon cometh, but not here today.
Me too. I've got a jacket, but I got a cotton shirt on underneath. I'm ready to go for the warm weather.
All right. She is fired up and ready for big things. We walk in, we slide into the chairs, we put the headsets on, and we're looking at this thing called usdebtclock.org, and it looks like a pinball machine with lots of flashy numbers. So throughout the day, I'm going to start the show with the U.S. national debt is currently at $54,709,111,600,000, and a number that's moving so fast I can't take my eye off it. Jeff Davis, please help me. I'm going to read this number throughout the show and see where we get.
I bet you did good in math to read those big numbers like that.
Amazing. But this thing is like... I'll just put it this way. The hundreds of thousands since the time I started has gone up 200,000 in that 20 seconds.
Jeff, do you think that's really true or not? I mean,
Oh, yeah.
I want your opinion on that.
I think so.
Yeah.
I think so. It's the us.debtclock.org if you want to look at it. And, I mean, it's obviously pretty scary because it's going to be talking about, it shows how much is the actual debt for each family. What is it? $99,556 per family. So that's savings. The debt is $1,517,000 per family.
Good goobity moo.
That's the total debt per citizen of $350,000. So because you live here, you now owe $350,000.
Well, all right. I'm going home. Goodbye. Good night, everybody.
There's gold in them bar hills.
Well, that 114 million of that national debt has now gone up to 115 million. Mm-hmm. But realize that's part of the 54 trillion. So we'll see where we end up, say, mid-show. But, hey, the revenue number's moving as well.
That's
it's
right.
Not nearly as fast.
Well, I think that was one of the things that was talked about a lot this week was the budgets. We've gotten a Republican budget, and the Democrats, for the first time in 4 years, have passed a budget through through committee at least, and so it's out of their committee. Democrats voted for it, Republicans voted against it. So, got a feeling this is going to be pretty much of a party line. But what they are is setting out their bargaining positions. The Democrats, want to have something like a $1.5 trillion worth of tax increases over the next 10 years. Mm-hmm. And then the Republicans are asking, to do it without raising those revenues. So, how much of the revenues, both of them are starting out with extremes. And then they have to try and negotiate into a middle ground. And that's traditionally how it's always been done. But, with the current administration, they found it more expedient to put aside the budgeting process and just operate on continuing resolutions. It allowed them to artificially increase the base number. And now the base number is based on numbers that go back to 2010. So it's going to be a very interesting process watching it happen. There's going to be lots of arguing, and the argument is becoming so typical that I can tell you what it's going to be, before it even starts. The Democrat position is that the Republicans are not in favor of helping the poor and the middle class. They want to only help the rich be able to afford more corporate jets. And the Republicans are going to say that the Democrats are only interested in soaking more people for more money, and it's everybody, not just the it's not just the corporate welfare, corporate jets, and that they don't want to cut any, but they don't want to cut any of their expenses. And for a lot of this, they're not talking about that. They speak a different language. They might as well be speaking French and talking to me, and I'm looking at them going, what are you talking about? Because when they're talking about these drastic cuts in the budget that somebody wants, what they're talking about is not a cut in the budget, but a cut in the growth of the budget. That's so maddening to me that the White House, I don't know why they did it, but the smarmiest guy in the world is Jay Carney. I just like that man so much. Every time he comes on, talking, he's probably the right guy for the president, but he's not the right guy for me.
Hey, folks, if you'd like to call and tell us who the right guy for the president is, the phone number is 877-975-9825. That's 877-975-9825.
Now, one of the things that you're seeing that all of this is going to is this helping the stock market go higher?
Mm-hmm.
What is making the stock market go higher, and what should people be doing today? And those are, I think, important questions that we are getting a lot of discussions with. Now, I think personally that the stock market this is not the time to be chasing a return. This is the highest the stock market's ever been. There's been a 4-year bull market. So we've got a market that's gone up for essentially four straight years. Since the bottom of the stock market, March the 9th of 2009, that was last Saturday, was the bottom. That was the anniversary. Bottomed out at 6,500. And now what we've seen is it go from 6,500 to over 14,500. Now is not the time to get excited about the stock market. Is it too soon to sell? If you were trying to time the market, we don't try and time the market. But if I've got cash, I'm not investing the cash today. I'm waiting for this market to pull back. This is a very traditional trap market right now,
Mm-hmm.
because it's humanistics is what they call it in our business. What we've got is the human condition says the market is doing well, I want to invest. The market is doing poorly, I want to get out. Traditionally, people buy high and they sell low. So if you've been pulled into the stock market today, quantitative easing, and guys, I see we got a couple calls we'll get to in just a second. Let me just finish this thought. Quantitative easing was designed to make interest rates low and the environment for interest rates low for an extended period of time and make you so uncomfortable with low interest rates that you would bite on risk again, because people were so intimidated by risk. So they had to get people back into the risk markets, that's the stock market, to be able to drive the stock market up. If the stock market's going up, the hope is that that'll help people feel better about the economy. Consumers will spend more money, and that will help us to generate an expansion cycle.
Come back.
So the quantitative easing is helping to has forced people to say, I'm tired of getting nothing at the bank. I'll take a little risk. And they've started taking a little risk. Well, now a lot of people who've been on the sidelines are saying, wow, look, the markets are back and they're doing better. And they're going to jump into the stock market at 14,500. And then when the 10% pullback comes, and I think there's a 10% pullback coming sooner rather than later, that 10% pullback comes into the market, that drops at 14.5. We're talking about a 1,450 point drop in the market. 1,000 points gets us to 34. Now we're talking about getting down to, the high 12,000s, 13,000. This market dropping to 13,000.
Mm-hmm.
When it does that, a lot of people are going to say, I told you the stock market is no good. I'm getting out and I'm never investing in the stock market again. It's a game to take all my money. They just lost 10% of, everything I got. And it happens every time I invest. It's because every time you invest, you buy high and you sell low. One of the things theoretically about investment advisors is we keep people invested when they don't want to be invested. We get them invested when they don't want to be invested. We get them out when they want to be invested. So now is not the time. I've got a couple of clients that are going, well, why do we have so much cash in our portfolios? Because, you hired us to get through these things, and, we are uncomfortable with this market. But you're only missing it if the market doesn't go back down. Because if it goes down and we buy in, and when it goes down, then you did really good, right? Oh, yeah, well, the idea is buy low, sell high, not buy high. And right now, anything you buy, you're buying high. You're buying at the top of the freaking market. So that's my little lecture on buy low, sell high today.
I'm going to bring Big Bob on. Bob, how are you today?
I'm fine. Thank you. I have a question that should only take a minute.
You're on the clock now, Bob.
Okay.
And
I am 72 years old, and I have been taking a what do you call it?
Required minimum distribution?
Minimum required distribution.
Uh-huh.
And that's a hard word to say. I hate it. And for my IRA. Now, in that IRA, I bought, I took a position with AIG. I bought it at $3.
Oh,
and
you've made some money, haven't you?
I got some warrants.
Right.
Okay, now, these warrants are good till 2020 for $45. Now, when I go to exercise those warrants, could I, given the fact that you can't put anything into your IRA?
Right.
That's
Yes.
the question.
Yes, you can, because those warrants are already in the IRA, and they're they are not an actual contribution. When you purchase those $3 per share AIG pieces of stock, you got the warrants as part of the purchase. So they're actually part of the IRA.
Still working
But
inside the wrapper.
I still have to add $45 per warrant, do I not?
Yeah, but that's really doesn't become an issue till distribution, correct?
Well, he's asking whether he can put that $45 per share into the IRA to fund the warrants. I think you can, but it's a great question that I will have an answer for you next Saturday, for sure.
Okay, that's good, because I
I think you can, but I could be wrong.
All right, or maybe I could turn other interests into cash and buy the stock from. Sure,
you could. That's another way to do it. I'm thinking through it as we're talking. I don't know that you really want to put them in the IRA, because then you would lose any capital gains treatment. You'd really rather own those outside, because remember, if you own them in the IRA, they're going to be taxable as income. So whatever your income tax bracket is, they go on the very top of your tax bracket.
How could I get them out of the IRA?
Well, what I'm wondering is whether if you had the option, if there was an opportunity to exercise those warrants without exercising them through your IRA, I would think that it might be worth doing that, even if you made a distribution from the IRA, paid the tax on that, so that you don't incur any additional tax on the gains of the warrants. Does that make sense?
That makes sense. Yeah. See, I have some cash, and I haven't taken this year's required distribution yet, and I was thinking of exercising those warrants now with that cash.
It's probably I don't know that I would do it today, but I think that those warrants are, AIG I think is out of the woods, and they seem to be doing much better. I mean, they always did well. They got caught in a bad bet, just like J.P. Morgan got caught in a bad bet with the trading that they did last summer, and they lost $5 billion. It happens. Frankly, AIG should have gone out of business, reorganized, and essentially that's what they did. They reorganized, and for all intents and purposes, they were technically bankrupt, and they've built this business back again. They're not many companies have.
I just increased my position in AIG outside of the IRA in a regular account.
I remember I tell a story when we talk about quality of companies and investing in annuities. We do sell some fixed annuities. Fixed annuities are like, I would liken them to a tax deferred CD, but annuities, are backed by an insurance company. So this goes back to May of 2008. We had a client who had never taken any risk. Everything was always invested in fixed annuities. I tried to get him to take a little risk, and no, Jeff, we're not taking any risk. I worked too hard for this money. I'm not losing it. And he made money all through the bad decade. And we had a very large annuity that came up for maturity, so we could go out and shop, get the best rates. And as we looked around, May of 2008, I went to the largest insurance company in the world with the highest level of standards. They were recognized as being the pillar of the investment community, and we put this very, very large chunk of money in AIG. And not 6 months later, we were trying to figure out whether or not we're going to get any of it back. You could do all the research on the front end to determine this is a good company, but there's things that happen in the world that we call them black swan events. Those black swan events can really alter what a company's outlook is going to be, and that's what happened to AIG. Now AIG I think they learned some of their lessons. They're clearly on a path that's going to be sustainable, and for someone like yourself, I think you're making some good decisions about the investments you're making.
Thank you for your comment. I really appreciate that. I look forward to next week's show.
Sure. Thanks, Bob.
Thank you, Bob. Now, there's a gentleman who bought low.
Ha 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 ha! He bought very low.
Oh, and by the way,
he actually probably took a gun and a mask in there to buy those stocks.
Way to go, Bob. Good work. And while we've been on the air, the national debt clock has increased $26 million. Was that fun?
I'm sorry, Mac, we lost you, but if you want to call back, we'll get you back on the air. So is Bob still on there, or did we lose him? Or okay, I saw the red light on the.
I'm afraid to hit the button.
Just
yeah,
push.
Got it there.
I would just keep pushing buttons until it went away.
Isn't that how you start a new? Lisa, come back! Come back! Are you okay back there? You were talking about buying high currently. If you're someone who's currently invested in the market,
yes,
and you need a chance to pull back, you want to turn down the risk throttle. There's also the conversation about bonds and the fear of bonds. The normal vehicle we go to is to move from equities to bonds, and there are other tools out there that are available to turn down the risk. What comes to mind to you first?
Well, I think that the fear in bonds is oversold.
Mm-hmm.
Now, I think you have a much higher risk if you own individual bonds. And just as a reminder, the way that bonds work is they have a price, a daily price. Let me take a step back. People buy bonds with an expectation of guarantees. I'm guaranteed that if I buy a $10,000 10-year Treasury today, that in 10 years you're going to give me back $10,000. And I'm going to get some interest rate paid to me every year on a guaranteed basis. Now today, if that interest rate is 2% and you pay $10,000 for your bond, and interest rates go up to 5%, a lot of people who bought them at 2% are going to be unsatisfied with the 2% return, and they want to get the 5% guarantee. The way that bonds work in between the day you buy them and the day they mature is they're priced every day. So the price could be higher or lower any day you look at a bond, and it's going to be a function of what interest rates are. So if you have a 2% bond and you want to sell it, but I can take my $10,000 out and buy a $10,000 bond that's paying 5%. Why would I buy your bond that's only paying 2%? I'd buy it because you're selling it to me for $8,000.
Mm-hmm. Deep discount.
A discount.
Mm-hmm.
And when I evaluate bonds on an individual basis for our clients, we want investment grade. That's triple B and above. We want intermediate short-term bonds. We don't want to be in a 10-year bond, and we want to be in the last 2 or 3 years of a 10-year bond. And we want to buy them on a discount. If I can't identify a discounted, short-term, intermediate, investment-grade bond, we pass on individual bonds. So that's our criteria. That's where we screen out bonds for our clients on an individual basis. because of the risk. There's a tremendous amount of risk in the individual bond market today, just like there's a tremendous amount of risk in the individual stock market. The markets are full of risk today. They're going to pull back. Interest rates will go up. Stock market will come down, and there'll be less risk, and then the stock market will move forward. 2 steps forward, 1 step back, 2 steps forward, 1 step back. We call this the Davis Shuffle.
Cha-cha-cha.
There you go.
Well, explain the difference in regards to your feelings on bond funds as opposed to individual bonds.
Well, I was going to say the second part of that, though, is if you bought it at 2% and the interest rates went down to 1%, then you could sell that. I want to buy your 2%, I got to pay you a premium. So the way the daily pricing of bonds work, if interest rates go up, the price of bonds go down. If the interest rates go down, the price of your bonds will go up. And that's if the interest rates go below what you bought, your price will go up. If the interest rates go above what you purchased, then your value is going to go down on a daily basis. Doesn't mean it's not guaranteed. It'll be, if you hold it, it's guaranteed. Doesn't mean that the interest rates aren't guaranteed. They are. Now, bond funds are funds that are buying and selling bonds every day. And some bond funds identify themselves just as short-term duration U.S. government securities. They're going to have a very low return. They're going to have not a lot of volatility. Other companies, other funds are high yield. High yield bond funds is another word for junk bonds. Do you remember the junk bonds of the 1980s?
Yepper.
Now, what they figured out in the late 1980s was that the default rate of high yield bonds wasn't any higher than the default rate for traditional investment grade bonds. So in terms of the default risk, there wasn't any higher of a default risk at that time. What they did was they created a model that attracted even more junk, and the quality of the junk went down so that the number of defaults went crazy. Just huge amounts of defaults. It became like somebody playing with free money, and which is what happened in 1998, 99 with the internet stocks. It's what happened with real estate, bubble after bubble after bubble. These are bubbles. So be careful about high yield bonds or high yield bond funds because they inherently are going to have more risk. Higher return, higher risk. Whenever your return goes up, it's a function of risk. The lower the return, the less risk inherently. Now, it's not an absolute, but traditionally your money market account gets you the lowest interest rate that you can, that's the lowest return, but it's the safest place to put your money. On the other hand, you're going to Las Vegas, you've got a pretty high risk that you're not coming back with your money, and so the returns can be pretty good. So it's the same thing with bonds and bond funds. You look for bond funds that are essentially, I like to think of bond funds that have some international components. So if one of the bond funds, I can't tell you which one on the air, but call us, we'll tell you, because I got to give you a prospectus if I tell you.
Well done, the attorneys. Thank you.
Thank you. But my favorite bond fund, which happens to be probably the largest bond fund in the world, doesn't own any U.S. government securities right now because there's not enough. There's too much risk for the return because they can take that same money and buy a Brazilian bond and get 5.5%. I think the Brazilian economy is not going to be in free fall. They've got more oil than anybody in the world right now, and they're figuring out how to get it. So Brazil is going to be a wonderful economic opportunity, and they're paying higher interest rates than we are. And even if the risk is the same, I take the 5%, and that's what these guys are doing. So they're searching worldwide for alternatives just to the U.S. government securities. So, if you're invested in U.S. government securities, I would tell you that you should be very cautious right now. I wouldn't freak out and sell everything tomorrow, but I'd be really cautious. If you start to see the unemployment come down, that might be a trigger for higher interest rates. Mr. Bernanke said that at 6.5%, they'll probably start to consider having interest rates go up. But these interest rates have been artificially kept down to make it so uncomfortable that you'll take risks with the stock market.
The auction, the government auction, and it was flying through the news yesterday. And by the way, now the national debt's gone up 46 million, so we're really moving there on that little ticker clock. But the bonds were still selling, but they saw their first tick of a slowdown in regards to, but that China bought more, but the rest of the world. How would that affect what would happen with it? Would it force the government to push interest rates up?
Well, it's an auction. They don't control that interest rate.
Mm-hmm.
We're talking about the 10-year Treasury.
Mm-hmm.
Okay, the 10-year Treasury. The Fed does not control the interest rate of the 10-year Treasury. That's a market dictated return.
Mm-hmm.
So what they're telling you is that not as many people want to give us their money right now. If not as many people want to give us their money, what are they going to do? They're going to increase the return for that 10-year Treasury bill
to make it more attractive.
They will lower it as low as they can on the other side. If they're getting the money, they're going to squeeze the investor who's buying bonds as hard as they can. So, whether it's 1.75 or 1.74, they're going to try and drive that interest rate down as low as they possibly can if there's an excess number of buyers.
Mm-hmm.
But when there's not an excess number of buyers, what they're going to have to do to attract those buyers is raise your interest rate, because I can go to Brazil and get 5%. Why am I going to give them, they're going to give me 1.7, or I can buy a Brazilian 10-year Treasury for 5?
Yeah.
I'm out of here. See you guys.
Yeah. Take care of your family, make your money.
This isn't this is business, and this is a worldwide business now. So the interest rates have got to be competitive with what people expect in terms of safety. But there's a sense of now it seems the waters are calming a little bit.
Mm-hmm.
Now, I don't know if this is just a breath that they're taking, or whether they really seriously are going to be making changes in the way they're going to approach things. I think that, we've got to get through this continuing resolution. That hasn't been resolved, so March the 27th is the date for continuing resolutions. Then we've got another debt ceiling coming up. And we've got 1 minute till the music. Dun-dun-dun, dun-dun-dun. Oh, wrong one.
Let's see here. We are now up $55 million on the U.S. national debt clock, and that's the last time I'm going to mention it, unless I got to fill 5 seconds at the end of the show.
Well, if you want to see what we've been looking at today, it's called usdebtclock.org. And when you first bring it up and you start looking at it, it's going to hurt your eyes.
Yeah, there's a lot of green and red there.
Well, yeah, and they're flying. Numbers are just flying because the debt's and it's got state debt. It's got breaking it down on an individual basis. You want to know how much you personally owe of the national debt, $350,000. Just a mere $350,000, Mr. Coleman. Can you give it to me today?
In my shoe, brother. Not a problem. Folks, if you'd like to give us a call at Falcon, the phone number is 352-375-7977.